Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle, as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber's report so as not to confuse them with the drivers operating behind them. As I mention every month, the drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. This month I'd like to do a little speculating with you, if you don't mind, on what may lie ahead for us and how it just might unfold. As such, I would therefore like to cover the following subjects shown here. Warren Buffett likes to use a broad view of equity assets compared to the GDP of the country. For years I followed it closely to spot risk situations not too dissimilar to this occurring now. I found it effective, but began to prefer the comparison of household financial assets compared to disposable income. In prior years, both kept me from being caught off guard by major directional shifts in the market. With the further rapid advancement of globalization, financialization, and coordinated central bank monetary policies, as in Bernanke's Enrich Thy Neighbor, I've been steadily shifting my key warning indicators to have a much heavier weighting globally. Specifically, I began tracking what I saw to be the major global drivers. Before I show you this, and what it appears to now be signaling, let me first place some of this in context. Remembering that the King Kong of trading markets in the world is the currency market at over $5 trillion per day, then followed by the global debt and credit market measured in hundreds of billions of dollars. Then in the rear comes equity and commodity markets measured in the many billions of dollars. As such, I have found that 1. The largest market shocks stem from the global trend changes, where these are best identified through financial flows between differing currency regimes. Other than wars, we have not experienced a crisis on a global basis in this regard, maybe other than the fallout from World War I flows, as represented by the credit expansion of the 20s, resulting in the 1929 stock market crash, and thereby launching the Great Depression. Financial crises have been more a country or regional phenomenon stemming from major dislocations of the country's currency. The 20% one-day crash of 1987 was primarily a U.S. dollar currency-driven action, which spilled over into debt, credit, and equity markets. A major shift in debt and credit associated with the U.S. housing industry resulted in the 2007-2008 market crash. A major volatility event associated with technology stocks in 2000 resulted in a dot-com bubble implosion, taking U.S. equity markets along with it to a significant degree. I don't recall seeing all these concurrently occurring, the closest being maybe 1987. The unholy trinity is setting up for just such an occurrence. I'm not saying it will occur tomorrow, only that it has a high probability of occurring, and if history is any indication, it is assured to happen. But that's just it. History never repeats, and there are factors coming into play which we will get into in a few moments that may change that. I'm not trying to say this time it's different. I'm trying to say things are continuing to change, and how it will unfold will be different. That we can be assured of. To fully appreciate the conundrum we, and more importantly maybe, the central banks specifically now face, we need to understand the importance of 3 major activities operating independently yet intertwined in 3 different areas of investment influence. I mentioned these briefly in this month's Under the Lens presentation here a couple weeks ago. The central banks have been heavily committed to quantitative easing and ZIRP after the 2008 financial crisis. This has produced credit and liquidity, which I will label flows. Corporations have been heavily committed to stock buybacks since the advent of quantitative easing and ZIRP. These activities have fostered major movements in equity valuations. Public investors have shifted from the use of active managers, that is, mutual funds, for example, to investment vehicles using quick entry and exit, such as ETFs, which have become dominated by those tracking the major indexes or popular assets such as the FANGs. This shift has fostered passive investing. Unfortunately, the unintended consequences of these three entities has the potential to now create a perfect storm. Central banks are reversing policy to quantitative tightening and normalization. Corporations are reducing the rate of stock buybacks, and public investors are heavily into passive investments that may lack liquidity if aggressive selling occurs, which is specifically the reason they were bought in the first place. Consider the degree to which these shifts are actually now occurring. Central bankers, quantitative easing, QQE, and ZIRP are now going to quantitative tightening and to normalization. Plans in the last 3 weeks have been clearly rolled out by the central banks, and most specifically the European Central Bank, in regards to what they don't call it taper, but I will call taper, and earlier this summer what the Fed referred to as normalization as it reduces its Federal Reserve balance sheet. This is obviously serious. But many don't believe the central banks will be able to follow through. Equally as serious is those dissenting from the Fed's view of the world, because they are signaling a recession or worse lies ahead in 2018. Either event is not good. The three quantitative easing programs in the U.S. have fostered a full array of unintended consequences that are ready to come home to roost, from risk parity and a plethora of investment strategies, to risky rehypothecated collateral chains, to diminishing trade liquidity due to higher capital regulatory requirements, and fiduciary risks. I can go on, all hidden, but there. And as Warren Buffett says, you never know who's swimming naked until the water goes out. And a lot of this will become very, very evident if we see a major contraction in the markets or drawdowns. Corporations have been the major buyers of stock markets since 2010. Share buybacks, however, are now falling, and their effect itself, even for the buybacks that are remaining, is being reduced. From an investment standpoint, we now have investors in passive investments, as I mentioned before, as represented by ETF growth, but the professionals are leaving the market, while meanwhile the public is rushing in. As professionals leave the market, it's the public that is taking up the slack. The psychological issue with the collapsing unholy trinity will be the perception of the withdrawal of the Bernanke-Yellen put. The central bank will no longer be seen to be supporting higher asset values in its quest to stimulate consumer demand through what they called the wealth effect. There was a wealth effect, but it became inequality. The rich got richer, the poor got poorer, and the middle class got gutted, and that's where the market is supported. This may be a bigger issue, actually, than the reality of the individual components here, and that is the lack of confidence that the central banks are now covering your back. As important and critical as the elements of the unholy trinity are, there is something occurring that is even more important in my mind. Charles Hugh Smith and myself began laying this out in a just-released 32-minute video discussion supported by about 44 slides concerning what we termed the big reversal. After 3.5 decades, the global economy has now entered what we see to be a 3.5-year period of slow rotational change. It's happening as we talk today, but it's gradual. It's like watching a glacier move. Debt, demographics, and disruption, that is technology disruption, have created deflation. This is in the past tense. The world is leaving an era which witnessed unprecedented global debt growth, workforce demographics, and the emergence of profoundly disruptive technologies. These trends, through globalization, labor arbitrage, and oversupply, have coupled to deliver slow inflation, disinflation, and even deflation in various areas of the world. What we've experienced during this era on a global basis is 1, a decline in real interest rates, which have been a prime supporter of asset prices, 2, a drop in real labor earnings in advanced economies, and 3, a meteoric rise in inequality within countries alongside a drop in inequality between them. What we are failing to realize, according to a major new research report released by the Bank of International Settlements in Basel, Switzerland, is an understanding of what these trends mean, which can only be seen when all three trends are examined together in a global context. And that's what we continuously fail to do. What we see is that interest, incomes, and inversion equal inflation. That's the big rotation. In the approaching new era, savings and investment will fall. However, what is critically important to understand is that savings will fall at a faster rate due to advanced economy social entitlement programs. As a consequence, real interest rates will rise, inflation and wage growth will pick up, and inequality will fall within countries versus rising within countries today. The leading determinants that must be analyzed are the importance of the role of China, the social safety net in advanced economies, and the global approach to the discussion of demographics. Regarding the fact that savings will grow at a slower rate than investment, and that gap will create pressures on interest rates, we need to appreciate that though entitlement programs will be cut, means testing will be put in place, etc., they still will be there, and they will still grow as more and more people retire. And as a consequence, their consumption, and the consumption that subtracts from savings. That, in the essence, is what's going to make this big change. As demographics kick in, millennials having less money, baby boomers now retiring and spending less, saving less money because their needs have changed. The magnitude of stretched financial markets, the unholy trinity, and the big reversal now coming into focus begs the question, what will authorities do to hold this together? Or are we imminently about to see a historic crash? Many are proposing and suggesting that's what will occur. I'm not saying that it's going to occur imminently. Are the financial charts about to look like the wellness cycle of a turkey, as shown here, where investors are the turkeys Wall Street will feed on for their upcoming Thanksgiving? At some point, yes, but I think Wall Street will also be trapped in this cycle. The answer actually lies in fully understanding that the powers to be will do everything and anything to arrest a financial crisis and maintain the status quo. That's a given. That will happen. The question is what they will do. We have witnessed time and time again they will change the laws, change regulations, put up tax barriers, or collude with other powers to make what they want to happen happen. And it will to some degree. It is one of the reasons we are watching what appears to be a market headed towards a Minsky moment. There is little doubt in my mind we are headed towards a de-dollarization event and a final hyperinflation blow-off, which I've mentioned in other sessions is first and foremost a currency event, an event that will lead to a fiat currency failure at some point. So how will this unfold? How can we make any sense of it as investors so we are somewhat prepared? Well, let me speculate with you for a moment and show you how I currently see it. No doubt this view will change as the real world unfolds, but it may be helpful in envisaging possible outcomes. Let me first consider the stages we have come through. Stage one was pre-dot-com, securitization and financialization, where debt began to dominate as an asset and considered an asset and invested as an asset. Stage two is where we really got into the central banks doing reflation through using regulatory and the central bank's Fed funds rate. Stage three has been the post-2008 Great Financial Crisis, where central banks used policies such as various versions of quantitative easing and ZIRP. In stage three, we started with what is labeled here B and have moved through various programs labeled to label E shown. In B, we had regulatory policies that got us out of the immediate impact of the 2007 financial crisis. That is FASB 157, where we jettisoned mark-to-market and still have to this day. It was only supposed to be a temporary measure, so that the books of the banks can be, they can make them mark them to whatever they decide they're worth. And that in itself was a massive problem that everybody's forgotten about. We went to things like conservatorships as reflected in Fannie Mae and Freddie Mac. We then went to monetary policies that we had never seen before, have never been tested. 11 to 13 various facility guarantees, zero interest rate policies, various versions of quantitative easing and quantitative and qualitative easing in the case of Japan, and now, and for the last 2 years, in many cases around the world, negative interest rate policies. In labeling D, we had this rotation of the central banks inflating their balance sheets in a policy that was labeled by Bernanke as enrich thy neighbor, therefore never really understanding where the debasement was happening. And the debasement was all relative to the other currencies. So fleeing one did not really get you out from under the currency cartel of the 4 currencies that control 95% of the world's currency market. That is the Japanese yen, the euro, the Bank of England's pound, and the United States dollar, all debasing together. And now we're into stage E, which is normalization in the case of the United States, where we're doing quantitative tightening and central bank balance sheet reductions. And in the case of the ECB, their form of taper, which has not been known as, it's not been called taper, but is nevertheless a reduction in its rate of buying of the bond markets. What lies ahead, in my mind, is likely stage 4, where we have this great reversal, a shift from deflation to inflation that I mentioned, probably unfold over the next 3 to 4 years. Stage 5, a Minsky moment. And stage 6, where actually we'll see a new world order, a new Bretton Woods, SDRs, an Asia-centric and multipolar kind of world. I've labeled these shifts in here as F through I in this schematic. That is, F will probably get asset buying. That is quantitative easing directed at equities, as Japan is doing right now, and differing from where quantitative easing has always been about the bond market. We'll see guarantees, various forms of interim facilities. We will see helicopter money, that is through forms of student loan forgiveness, universal income supplements. We'll see things such as conservatorships probably applied to public pensions. All of these will unfold as I think that what lies ahead most imminently will be a collateral failure associated with the degree of over-leverage currently in our financial system due to various reasons, one of which is the concept of rehypothecation and the $500 trillion swaps marketplace. That drawdown, that collapsing collateral, will prompt the facilities that I've labeled here, F through I, which will explode the markets higher. Whether they will actually get a new high may be questionable. Maybe an M top, double top. It may be a slightly higher high. It might even be a little lower. We don't know until we actually see these policies, how quickly they react, and how broad-based they are globally. But as we go through that, it will fail, because then we will begin to have a failure in the fiat currency. And that'll be primarily driven by a really rapid de-dollarization, which is already underway. It's become obvious with things such as the petro-yuan versus the petrodollar, remembering that the petrodollar is what keeps the US dollar out there, because our trade has fallen off so dramatically, and more countries are willing to take other currencies. And if they don't have to buy oil and energy in US dollars, as the agreement between Nixon and Saudi Arabia was arranged in the early 1970s, and if that changes, there are quite literally trillions of US dollars that will be returned, which will create hyperinflation and certainly a massive erosion in the US dollar. And as I said earlier, hyperinflation is a currency event, that is the devaluation or the unwillingness of people to accept the dollar. And I think it won't be so much as a gigantic sell-off as a slow and grinding process on the way down, with various violent bounces as we take ourselves to new lows. Clearly, a fiat currency failure lies ahead, which we have been signaling and following in this chart here since 2010. We have tracked closely to it over the last decade. On the other side of it is a new world order, as I mentioned. It will be multipolar world order with an IMF SDR-based international trade and balance of payment settlement currency, among many new institutional approaches and structures. It is all to be expected as globalization firmly takes hold and actually becomes fully operational and not simply run like it is today as individual fiefdoms. These are my current perspective and views. Be assured they will turn out differently, but at least you might have something to consider as a framework for reference going forward. As I often do, remember, they will print the money to solve any and all problems, and until such time as no one will take the money or it is of no value. That day is still in the future, as I've shown here. So take full advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react, especially when they're locked in with little choice. Your chances of success then go up dramatically. People make money in all markets if you're positioned correctly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening. May 2017 turn out to be an outstanding investment year for you and your family.